I have lived long enough to know that fear rarely arrives in the shape people expect. When fear is obvious, most people think they understand it. They think the danger is the headline. They think the danger is the war map, the breaking alert, the red candles on the screen, the television anchor speaking faster than usual. They think the danger is whatever sounds dramatic enough to justify the emotion they are already feeling. But in markets, the obvious story is usually not the whole story. Sometimes it is not even the important story. What I was watching in that stretch was a market that, on the surface, did not look deeply broken. The broad index was not collapsing in the classic sense. It was not yet one of those moments where you wake up and discover civilization has been repriced overnight. On paper, the drawdown still looked modest. Yet beneath that surface, you could already feel something harsher taking hold. Protection was getting expensive, sentiment was falling into panic territory, breath was washed out. Big money was behaving as if the house smelled smoke before the fire alarm went off. That is the sort of moment I respect. I do not respect panic because it is loud. I respect it because it often reveals where leverage, crowding, and lazy assumptions were hiding. Panic is the market ripping the mask off comfort. Panic tells you which positions were held out of conviction, and which were held because the previous month happened to reward them. Panic tells you who was liquid and who was only pretending to be liquid. So when I saw a market only modestly off the highs but already showing signs of internal fear, I did not look at it and say the world is ending. I looked at it and said something much more useful. I said the surface is lying. That is the first thing people misunderstand in a correction like this one. They think a market is healthy because the index has not fallen far enough to scare them. They think damage begins when the headlines say crash. But markets often weaken from the inside long before they break from the outside. One pocket of leadership rolls over. Another pocket gets crowded. Then money rotates. Then the generals stop advancing even while the army still appears to be standing. Then one day people look up and discover that what felt like calm was actually distribution. That was the condition I cared about. Not the shouting, not the panel discussions, not the moral theater that always grows around geopolitics. I cared about price positioning and the difference between what people believed and what the tape was already saying. The conflict in the Middle East was the spark for more volatility. Yes, rising oil and commodity stress were real enough, but I would have been making a mistake if I had told myself the entire weakness in the market came from war. It did not. The market had already spent months acting tired. Valuations were rich. The artificial intelligence trade had run hot. The easy part of enthusiasm had already been harvested. Questions around interest rates had not been settled. People were still carrying the habit of buying every wobble as if the market had a permanent obligation to rescue late entry. That is not how markets work. Markets do not owe you a clean continuation after a stretched run. They do not owe you a gentle correction. They do not owe you a narrative that feels fair. They move from excess to disappointment. The same way human beings move from greed to embarrassment. First slowly, then all at once. Then not quite all at once. Then in waves that make everyone feel stupid at different times. The shape of that decline mattered to me. This was not a straight line collapse. It was what I would call a rolling correction. The index was not imploding, but under the hood there was real transactional violence. Capital was rotating out of parts of the market that had become symbols of certainty and drifting toward the places people hide when they no longer trust certainty. The old leadership was being sold. Defensive groups and energy were catching flows. That sort of tape confuses the crowd because the scoreboard does not yet look catastrophic. Yet inside the machine, many names are already living through their own bear markets. When I see that, I do not ask whether fear is rational in a philosophical sense. I ask a far more practical question: how much of this fear has already been paid for, and how much of it is still ahead? That question matters because war itself is often misunderstood by investors. They hear the word war and immediately conclude stock market collapse. History does not support that simple conclusion. Markets do not fall just because the world has become uglier. They fall because cash flows get threatened, financing conditions tighten, commodities spike, expectations get repriced, and people discover that the valuation they paid assumed a softer world than the one they now inhabit. The commodity channel is usually the important one. Oil is the bridge. Oil is how a distant threat suddenly becomes a discount rate problem, an inflation problem, a margin problem, and a consumer confidence problem. Oil is how people who thought they owned a clean technology story wake up and realize they also owned a macro bet they did not understand. That is not panic first, oil first, then inflation fear, then rate expectations shift, then positioning breaks, then risk assets wobble harder than the public expected. A lot of people wanted to reduce the whole moment to a moral drama about war. That was not enough for me. Morality matters in life. It is not sufficient as a market framework. A market framework requires you to ask where the economic transmission runs. If oil surges because the Strait of Hormuz is threatened, you do not need every tanker to stop moving for the market to begin repricing stress. Insurance changes behavior before maps change. Traders change behavior before governments publish perfect clarity. Risk can tighten a system long before the formal shutdown occurs. That was the texture of the moment. The strait was not necessarily closed in the absolute sense, but the threat to passage was enough to move behavior, enough to make insurers hesitate, enough to change how people thought about supply, enough to put a premium back into oil. And once oil begins to carry that premium, markets do the rest of the work themselves. They start running the old equations: higher energy, slower consumer, stickier inflation in the near term, less room for central banks to ease, more anxiety around growth, lower appetite for richly priced assets, a stronger bid for what feels liquid and defensive. You could almost watch the machine translate one fear into another. I have always believed that one of the greatest advantages in investing is learning to separate first-order drama from second-order consequence. First-order drama is what everybody talks about. Second-order consequence is what prices. Most people never make that transition. They remain in a permanent state of reacting to first-order noise. They think they are informed because they know the headline. They are not informed. They are entertained. The informed person asks what the headline changes in the capital cycle, in rates, in margins, in positioning, in incentives. That is where the money is made. So I looked at oil, and I looked at what markets historically tend to do around violent oil shocks. That history does not tell you that every scare becomes a catastrophe. In fact, very often the opposite is true. Markets can sell off quickly on the shock, price disaster, and then recover long before the public feels comfortable enough to believe it. That is why a correction born of fear can be the most profitable sort of opportunity. If you know where you are in the sequence, if you buy too early, fear teaches you humility. If you buy too late, the opportunity has already passed to someone braver. The game is not to be fearless. The game is to know when fear has become overpriced. That is why I was not interested in theatrics. I was interested in sequence. Before the worst of the talk, I had been short. Then I covered. Not because I suddenly became cheerful, not because the problem disappeared. I covered because markets are not sermons, they are probabilities. A short position that has paid you can turn from intelligence to vanity very quickly. A man can be right on direction and still lose money if he falls in love with his own timing. I have seen far more fortunes damaged by overconfidence after a good trade than by ignorance before one. Covering the short did not mean the all clear. It meant I respected the distance already traveled, the oversold conditions building underneath, and the possibility that panic could produce a relief move even inside a broader correction. A market can be sick and still rally. A market can be dangerous and still rip hard enough to punish people who confuse conviction with inflexibility. That is why I never let one idea become my identity. The market does not care about your identity. It cares only about whether you paid the right price for risk. That distinction saved me many times. As I watched the market approach the 200-day moving average, I thought less about certainty and more about territory. Territory matters. Some price zones are not magical, but they are meaningful because they change behavior. They force institutions to reconsider. They force trend followers to slow down. They force investors to ask whether they are still dealing with noise or whether opportunity is beginning to enter the room. The 200-day moving average is one of those areas. It does not guarantee a bottom. It does not prevent further pain. But it changes the quality of the decision. And in markets, quality of decision is by then. Fear had become visible in several places at once. Sentiment had deteriorated sharply. The cost of protection had expanded. Breadth had weakened. Oscillators were reaching oversold territory that usually belongs to harder corrections than the one visible on the index itself. That mismatch told me the internal pain was greater than the headline drawdown suggested. People think panic must look dramatic to be real. It does not. Panic can exist in a market that is only down modestly if enough of the ownership was concentrated, complacent, and crowded. Panic is not defined by the depth of the index. It is defined by the fragility of the people holding the risk. That is a lesson worth remembering in every cycle. The other lesson is that not every correction deserves the same response. Some are valuation resets, some are liquidity accidents, some are macro scares, some are the beginning of a bear market, some are just the market shaking out borrowed confidence. The hardest thing is that they often look similar in the early stage. That is why I try to work through the mechanism rather than the emotion. In this case, the mechanism was telling me something specific. If oil remained elevated and no genuine off-ramp developed, the market would have to keep pricing a more stagflationary world. A stagflationary world is not one the market enjoys. If growth slows while inflation anxiety stays high, the central bank is constrained. Investors who are counting on lower rates must reassess. The valuation multiple paid for long-duration growth suddenly looks a little too romantic. Consumers who are already tired have even less room. Europe, more vulnerable to the energy shock, becomes part of the pressure channel. The dollar can strengthen as people rush toward liquidity. And the unwinding of popular trades can become self-feeding. That is not a doomsday prophecy. It is just arithmetic. The arithmetic matters because the United States might not be directly dependent on that passage the way other regions are, but markets do not stop at national borders. If Europe gets squeezed harder by energy, if growth expectations deteriorate, if global risk appetite weakens, America feels it through earnings, through capital flows, through financial conditions, and through psychology. A problem does not need to strike your front door first in order to reach your portfolio. That is why investors who reason only from direct exposure often miss the bigger move. Indirect pressure is still pressure. So I kept two ideas in my head at once. The first was that mass fear often creates opportunity. The second was that not all fear has fully burned itself out when it first appears. The art is in knowing whether you are being offered value or merely the privilege of buying someone else's unfinished panic. For traders, that distinction is everything. If I were managing the moment as a trader, I would not pretend to know the exact lifespan of the conflict or the precise headline that resolves it. I do not know which political off-ramp either side will accept. I do not know which announcement will calm markets or which surprise will inflame them again. Anyone speaking with certainty in a tape like that is selling confidence more than insight. I do not buy confidence for its own sake. I buy favorable odds. The favorable odds in my mind depended on what happened after a relief bounce. If the market bounced but oil stayed stubbornly elevated, volatility remained high, and no real resolution appeared, I would treat that bounce as suspect. Not because rallies are impossible in bad markets, they are common, but a rally without a healing mechanism is often just pressure released before the next move lower. In that case, hedges come back into the conversation. Shorts come back into the conversation, not blindly, not theatrically, and never as a moral statement, but as a response to an unresolved macro problem wearing a temporary smile. That is how I think about tactical risk. Volatility itself also matters. People often fear the VIX because it looks like a pure fear gauge. But what matters to me is not that it rises. What matters is where it closes, how extended it becomes, and whether the panic is reaching levels that historically contain their own reversal. Instruments tied to volatility decay over time. That decay is a powerful thing when fear peaks and then retreats. but you cannot use that truth carelessly. If volatility pushes beyond a threshold and holds, panic can become more violent before it reverts. Timing matters. Price discipline matters. The crowd loves easy formulas because they spare people from judgment. Markets punish that laziness. Oil required similar discipline. I had no interest in chasing a vertical move after the world suddenly remembered energy risk. I have learned that crowded commodity chases often reward the first buyer and punish the late storyteller. But that did not mean there was no opportunity in the energy complex. American oil companies, particularly those positioned to benefit from stronger crude prices, stood in a very different place from investors who were simply buying fear at the top of the move. Businesses with real cash flow leverage to crude can gain meaningfully while the price remains elevated, even if the commodity itself eventually cools. That is a different sort of opportunity. It is grounded in operating leverage rather than pure panic. The important thing was not to confuse one opportunity with another. If crude remained high for a while, American producers could benefit. If crude eventually cooled as the fear premium dissipated and the political temperature dropped, there could later be a short on oil itself. Those are separate moments. People lose money because they collapse them into one. They hear a good idea at the wrong time and blame the idea rather than their impatience. Timing is not everything, but bad timing can ruin a perfectly good thought. Investors needed a different framework entirely. Traders and investors often use the same vocabulary and mean completely different things. A trader can be correct for 3 hours and make a fortune. An investor can be wrong for 6 months and still end up very rich. Confusing those time frames is one of the costliest mistakes in finance. If I were speaking to a long-term investor in that environment, I would not begin by telling him to heroically buy the index at any price, simply because fear existed. Fear by itself is not a bargain. What I would say is this: look for where quality has already been punished. Look for where good businesses are no longer wearing absurd optimism. Look for the parts of the market that have already taken a real beating, while the broad averages still flatter the casual observer. That is where opportunity often hides during a rolling correction. Some of the big quality technology and software businesses had already suffered significant drawdowns from their highs. That did not make them automatically cheap in every case. But it did mean the conversation was changing. Once a quality company goes from being priced for perfection to being priced for doubt, the future return profile can improve dramatically, even if the short term remains uncomfortable. That is the sort of discomfort I prefer. I would rather endure temporary volatility in a strong business than cling to cash while my purchasing power quietly dissolves. That last point is one the public resists until inflation teaches it personally. Cash feels safe because it does not move around on the screen, but a thing does not need to move in order to lose value. Cash can grow smaller in silence. That is one of the most dangerous illusions in finance. People think risk is what feels unpleasant. Often the larger risk is what feels calm. A person sitting in cash through an inflationary decade may feel prudent while becoming poorer in real terms, year after year. Then when fear finally arrives and assets go on sale, he finds he lacks either the nerve or the habit to buy them. That is a tragic combination, because the great fortunes are not usually made by the people who panic first. They are made by the people who prepared for panic before it arrived. The first seller in a shock is often not the wisest man in the room. He is the man who needs the money, lacks the temperament, or never understood the risk he owned. The buyer on the other side is usually not calmer by accident. He prepared his liquidity. He trained his mind. He studied the pattern. He expected fear to return, because fear always returns. This is why I never want the crowd's approval in a decline. I want their inventory. A correction near ordinary levels can be useful. A deeper correction, the kind that approaches the high teens, can become extraordinary. People use grand words too easily in markets, so I avoid them most of the time. But there are moments when broad weakness, extreme pessimism, and a still functioning long-term economic machine combine to create rare entry points. If the market were to sink into that sort of zone, filling larger gaps and forcing the public into full emotional capitulation, I would not treat that as a tragedy alone. I would treat it as inventory being marked down by fear. I have seen enough cycles to know how ridiculous that sounds in real time. When the screen is red and the news is frightening, it never feels like a gift. It feels like the beginning of something worse. Yet when people look back at prior panics, they always wish they had bought more. They say they would give anything to buy those drops again. They would not. Of course, what they mean is they would love to buy them with the comfort of hindsight. But the market never sells you bargains with comfort included. The discount exists because comfort has been removed from the package. That is the deal. So the question was never whether volatility would disappear overnight. The question was whether I was looking at a market that was finishing a repricing or only beginning one. And my answer was conditional. If the headlines improved, if oil cooled, if volatility retreated, if the market stopped behaving as though it were still pricing the worst plausible macro path, then the odds of a durable relief move improved. If instead we got a bounce while the deeper pressures stayed in place, that bounce deserves skepticism. That is not cynicism. It is discipline. Discipline is more valuable than bravado in a tape like this. I would also remind myself that corrections are normal. The public always acts surprised by them, as though a market that rose sharply should somehow continue rising uninterrupted, because investors have grown accustomed to being rewarded for impatience. That is fantasy. A market that never corrects would be a market that never clears excess. And a market that never clears excess eventually creates a worse problem than a simple correction. It creates delusion. Delusion is expensive, so I do not resent corrections. I study them, I prepare for them. I try to distinguish the healthy one from the dangerous one, the temporary repricing from the structural break, the crowded sell-off from the true change in regime. I do not always get the distinction perfect in real time. Nobody does. But a disciplined framework beats emotional improvisation over a lifetime. The framework here was not complicated. Even if the execution required patience, the market had been stretched before the geopolitical shock. Fear had become visible internally before the index fully reflected it. Oil was the key macro transmission channel. The central bank looked less likely to provide easy relief if inflation fears remained elevated. The crowd was panicking while still pretending this was a shallow problem. Traders needed to respect relief rallies, but stay alert to unresolved macro pressure. Investors needed to think in years, not in days, and focus on quality valuation and the willingness to buy discomfort rather than chase certainty. That was the entire playbook, though I dislike that word because it makes people think a market can be reduced to recipes. A market cannot be reduced to recipes. It can only be approached with temperament, judgment, and a willingness to change your stance when the evidence changes. I had already changed mine once by covering the short. I would change it again if the facts demanded it. Stubbornness is not wisdom. Flexibility anchored to principle is wisdom. The principle, for me, never changes. Buy value when fear misprices it. Protect capital when optimism overpays for risk. Refuse to let headlines do your thinking for you. And above all, do not waste a panic. A panic is painful. Yes, it damages confidence. It humiliates late buyers. It exposes foolish leverage. It invites awful commentary from people who were absent during the advance and now suddenly sound prophetic during the decline. But panic also creates asymmetry. It creates markdowns. It creates dislocation between what a thing is worth and what frightened people will sell it for. That is where the long-term investor earns his keep. The irony is that most people agree with this in theory and fail at it in practice. They say they want opportunity, but what they really want is reassurance. They say they want bargains, but what they really want is a crowd already validating the purchase. They say they are long-term, but what they really mean is they are optimistic until the screen gets uncomfortable. Then their horizon collapses from 10 years to 10 minutes. You cannot invest well that way. You must decide beforehand what kind of person you will be when fear arrives. Not afterward, beforehand. You must know whether you will need headlines to soothe you or whether you can think independently while the room is tense. You must know whether you are keeping dry powder for genuine opportunities or whether you spend it all chasing the previous narrative. You must know whether you are studying the internal character of the market or merely watching the index and telling yourself everything is fine because the headline number still looks tolerable. That period in the market was a perfect test of those questions. On the surface, it looked manageable. Underneath, fear had already started to bite. The world was noisy. Oil was doing the damage that wars often do through markets. The central bank's room to rescue expectations looked smaller. Tactical opportunities existed for traders, but only with discipline and humility. Larger opportunities were being prepared for investors willing to think beyond the next week. And that is where I always want to end up. I do not need to predict every candle. I do not need to impress people with precision. I do not possess. I do not need to know the exact day the conflict cools or the precise level at which a violent rally begins. I need only remain sane while others become emotional. I need only keep enough cash and courage to act when prices become attractive. I need only remember that history is full of moments that felt unprecedented to the people living through them and entirely recognizable to the people studying them later. This time never feels like the last time while you are inside it. That is why so many people talk themselves into paralysis. But the market's deepest pattern rarely changes. Excess builds, fear erupts, weak hands sell, stronger hands buy, time passes, the headlines age, the assets remain. That is why I refuse to worship panic and refuse to flee from it. I treat it as information. If the fear is unfinished, I respect it. If the fear is overpriced, I buy from it. If a rally appears without any healing in the underlying pressure, I distrust its charm. If a broad correction starts offering quality businesses at prices that finally compensate me for uncertainty, I lean in. If cash is slowly decaying while good assets are being thrown overboard by frightened sellers, I know which side of that exchange I want to be on. I want to own what panic made cheap. That is not because I enjoy chaos. I do not. It is because the world will always create another scare, another conflict, another inflation worry, another growth wobble. Another season in which the crowd confuses price movement with permanent truth. The investor who survives is not the one who avoids every shock. It is the one who learns how to read them, how to price them, and how to use them without becoming their prisoner. When fear spreads through the market, most people ask whether they should hide. I ask a different question. I ask what is being sold by people who no longer trust their own judgment. And when the answer is quality at a discount, I know that panic, for all its ugliness, has finally started to become useful.